What if your investments paid you a paycheck while you slept? That is the idea behind dividend investing, and most Canadians completely misunderstand it. A dividend is simply a slice of a company's profit, paid out to shareholders, usually every 3 months. If a stock pays a 4% yield, you collect about $40 a year for every $1,000 you own. Reinvest those payments and they buy more shares, which pay even more dividends, and that is compounding doing the heavy lifting. Here is the Canadian advantage. Hold your dividend payers inside a tax-free savings account, and every cent of that income is tax-free. In 2026 you get $7,000 of fresh room, and up to $109,000 if you have never contributed. Outside that shelter, eligible Canadian dividends still get a special tax credit that lowers what you owe. But remember, a very high yield can be a warning sign, and on payday the share price usually drops by the dividend, so it is not free money. This is education, not advice. Figures current as of 2026. Always check the latest figures with an official source.